Okay, let us revise what are the steps involved in public issue. So first step is to call a board meeting, pass a board resolution for public issue. Then second step is to call the meeting of shareholders and pass the resolution in the shareholders meeting. Step number 3 is to appoint merchant bankers and other intermediaries and enter into an MOU with them. Okay, because these are the people who are the going to execute your plan, and other intermediaries like underwriters, bankers, registrar, broker are appointed and you enter into an MOU. So these are the 3 steps we have discussed in the previous lecture. Now the fourth step is preparation of draft prospectus and its approval by the board. Which board? SEBI. Okay, because we have seen before you file the prospectus with registrar, you have to submit a draft prospectus with Securities and Exchange Board of India. They will go through the prospectus, draft prospectus, they will suggest the change, and after incorporating those changes, you will file a prospectus or red herring prospectus with the registrar. Okay, so apart from the notice of offer to issue shares to public, prospectus should also disclose justification of premium if called. So what you will include in this prospectus or draft prospectus? In case if the company is charging premium, why? Justify. Net asset value, high and low price of share of the company for the last 2 years. Highlights of the issue, main features of this issue, as well as risk factors. Let the investor be aware about the risk factors. And 5, a clause that company shall refund the entire application money if the minimum subscription is not received. Okay, this you have to mention in the draft prospectus. And point number 6 is a statement by the lead managers that in their opinion the assets of the underwriters are adequate to meet their obligation. What is the function of underwriter? They give guarantee in case some securities are not subscribed, they will subscribe the unsubscribed portion. So lead manager has to give their opinion that whether the assets of the underwriters are adequate to meet their obligation. It should not happen that underwriters say no, now I can't pay the amount for unsubscribed portion. This is step number 4, preparation of draft prospectus and its approval by the board. Then after the draft prospectus is approved by the SEBI, filing of prospectus with SEBI or registrar of companies. The draft prospectus along with the copies of the agreement entered into with the lead manager, underwriter, banker, registrar and broker to the issue had to be filed with SEBI and the registrar of company. Okay, so this prospectus plus this agreement with different intermediaries will file with SEBI and ROC of the state where the registered office of the company is located. And then you have to also pay the fees. Along with the fees and other prescribed requirement, for example, underlined with due diligence by merchant banker. After filing the prospectus with ROC, you have to intimate the stock exchange. Okay, because you have to tell the stock exchange we plan to get our security listed. So next step number 6 is intimation to stock exchange. a copy of MOU, MOA, Memorandum of Association, AOA, Article of Association, has to be sent to the stock exchange where the shares are to be listed for approval. So this is intimation to stock exchange. Point number 7 is finalization of collection center. What is collection center? The collection centers are those which will collect the application form. So the lead manager finalizes the collection center so that the prospective investor can collect the application forms along with the prospectus. So if you are making a public issue, you can raise funds from large number of people in the country, but from where they should go and collect the application form, from where they should collect the prospectus. So they will finalize all these details so that person can go and apply, make the application easier for him. Nowadays, because of online, you can do it online also. But again, there are a lot of people who may not be very much familiar with the online application. So they will identify collection centers. Then after the collection centers are finalized, printing and distribution of prospectus and application form. So after receipt of acknowledgement card from SEBI, SEBI has acknowledged, yes, go ahead, and the intimation from registrar of companies regarding registration of prospectus, and ROC has also intimated, the company should take step to issue the prospectus underlined within 90 days of its registration with ROC. So in how many days the prospectus will be issued now? 90 days, counted from the date it is registered with ROC, Registrar of Companies. And then step number 9 is announcement and advertisement. Now the company will take steps to market the issue, raise the funds. For raising the funds, you have to make the public aware first that we are coming out with the public issue. So announcement regarding the proposed issue should be made at least 10 days before the subscription list opens. Underline, how many days before? 10 days. So you have to make a public announcement at least 10 days before the subscription list opens, so that the public who wants to invest will accordingly take their position. No advertisement should include brand names for the issue. Only name of the company you have to mention. Okay, no advertisement should include brand names for the issue except the normal commercial name of the company. Except the normal commercial name of the company or any commercial brand name of the company or commercial brand name of its products already in use. But basically you cannot use your proposed brand as a marketing tool here. Existing name of the company can be used, existing product and its brand name can be used. Okay. Then subscription list, as stipulated by SEBI guideline, the subscription list for public issue is to be kept open for at least 3 working days, minimum 3, and for a total period not exceeding 10 working days. So subscription will be open for how many days? Minimum 3, maximum 10 days. So you'll normally find in any IPO, if you read the newspaper, the issue is open from 18 September to 20th September. Okay, so 3 days normally it is open, but if they want they can open it for 10 days also, which is to be disclosed in the prospectus as well. So these are all SEBI guidelines you have to keep in mind. For 3 to 10 days the issue has to be open for subscription, and then the company will have to open a separate bank account. Application money received in public issue, you can't mix it with the normal bank or company's bank. Keep it in a separate bank account, and in that account all the collection of the proceeds, all the collection and the issue proceeds will be kept. Further, the date of opening and closing of the subscription list should be intimated to all the collecting and controlling branches of the bank. Okay, so that they know from when they should collect and when they should stop collection, with whom the company has entered into an agreement for the collection of the application form. This is step number 11, separate bank account. Step number 12 is minimum subscription. How much is minimum subscription? Is it 90%? In Companies Act 2013 also, and Companies Act 1956 also. So now the section number is 39 of Companies Act 2013. Prohibits allotment of securities where the minimum amount as stated in the prospectus has not been subscribed. Why do you think such provisions are there? If a company wants to suppose launch a project which requires 100 crore, but it has only collected 70 crore, which means that project cannot be properly executed. So what is the point in keeping 70 crore also? The project will get stalled in between only. So therefore the law says if you can't complete the project successfully, it's better not to take the funds only. Refund it. 90% is good enough. At least we are almost sure we will be able to finish, but less than 90 means you don't know with that amount can your project be successfully executed, and that is why there is a refund clause. I don't know whether this is told to you or not in the law batch. Told? Otherwise the project gets stalled, na? You can't move forward, you can't move backward. If you have to construct a road which requires 100 crore, you have only constructed 60 kilometer out of 100 kilometer. You can't move forward, now you can't move backward also. So that is why this kind of clauses are there. If the stated minimum amount has not been subscribed and the sum payable on application is not received within the period specified therein, what do? Then the application money shall be repaid, refund, within a period of 15 days, underline 15 days from the closure of the issue. All these numbers you have to keep in mind for true, false, MCQ, fill in the blank. And if the money is not repaid within such period, again what is the penalty? The directors of the company who are officers in default shall jointly and severally liable to repay the money with interest at the rate of 15% per annum. Underline 15%. So therefore, becoming director of a public company is not easy. You might end up paying from your own pocket also. That is why I am not a director of any public company. Paragraph 13. Soon you will, but when will that soon come? That we will see. Promoters contribution. This we have discussed. How much is the promoters contribution? 20% of the pre-issue or post-issue? Post-issue. A certificate to the effect that the required contribution of the promoter has been raised before opening the issue has to be obtained from a chartered accountant like you. So you have one more chance to earn fees. Okay, give a certificate, get some fees, and it has to be duly filed with SEBI that promoter's contribution has been received. Step number 14 is allotment of shares. A return of allotment in the prescribed form as given under Companies Act 2013 should be filed with ROC within 30 days of the date of allotment along with the prescribed fees. Again underline within 30 days. So you have to file the return of allotment within 30 days. In case the issue is oversubscribed, it happens sometimes. 1 lakh shares are offered for public, 2 lakh shares are applied for. The basis of allotment has to be decided in consultation with the stock exchange authorities as per the guidelines laid down by the stock exchange. So company has to sit with the stock exchange authorities and decide whom to allot the shares. You have studied in your accounts batches also, pro rata allotment. But it's not that easy as it is taught in your accounts batches. A lot of factors are taken into consideration. Okay. Then compliance report. As stipulated by SEBI guideline, within 45 days of the closure of the issue, a report in the prescribed form along with a compliance certificate from whom either a statutory auditor or practicing CA or by a company secretary in prescribed in practice has to be forwarded to SEBI by the lead manager. That is compliance report in how many days? Underline 45 days. 45 days from which date? Date of closure of the issue. Who can give this certificate? Either the statutory auditor, practicing CA, or a practicing company secretary. And it has to be forwarded to SEBI by the lead managers. Then issuance of share certificate. That is, if the shares are not on the demat form, then this procedure will be applied. As per the provisions of Companies Act 2013, the company should deliver the share certificates within 2 months from the date of allotment of shares. Is right? So how many steps are there in this whole procedure? Just 16 steps. So I'll just quickly read it, and in case if they ask a question, write the proper sequence of steps involved in public issue. The first is board meeting and passing a board resolution. Second is holding of general meeting. Third is appointment of merchant banker and other intermediaries and entering into an MOU with them. Fourth is preparation of draft prospectus and its approval by the board. Board means SEBI. Fifth is filing of prospectus with SEBI and registrar of companies. Sixth is intimation to stock exchange. Seven is finalization of collection center. 8 is printing and distribution of prospectus and application form. 9 is announcement and advertisement. 10 is subscription list. 11 is separate bank account. 12 is minimum subscription. 13 is promoters contribution. 14 allotment of share. 15 compliance report, and 16 is issuance of share certificate. You'll be able to remember. Say yes. Okay. Answer in descending order, starting from 16 going till 1. Homework. Tomorrow I will ask. Okay. Remember and come. In reverse order you have to answer. Open book exam, but who knows, in your book that page is missing by mistake. Then you are not allowed to exchange the papers. Public issue of share book building route. Some discussion on book building route. Now many IPOs are coming out in the market which has book building route, where the investor gets a chance to determine the price. So it is not a fixed price route. The company will give you a price band or a floor price. Either you have to bid in that floor, that price band, or if floor price is given, then the cap can be at the most 20% more than the floor price. Company will collect bid from investors. Once the issue is closed, the subscription list is closed, they will decide a cutoff price. And those who have bidded above that cutoff price, they will be allotted the shares. Those who have bid below the cutoff price, Tata, reject. Cutoff point is 620. Some has bidded at 620, some has bidded at 630. 630 will also be allotted because he is willing to. but he is willing to pay up to 630. Company is saying we are charging 620 only. So all those above 620 will be allotted because they are willing to pay 620 or more. It will be refunded. It will be refunded. Once the issue closes at 620, the extra amount will not be kept by the company. So securities premium will be anything above face value. But those who have subscribed above, it is refunded. We will discuss the concept of ASBA in this case. So only whatever amount is finalized by the company will be transferred to company's bank account, and whatever amount is not to be taken from the shareholder is unblocked, and then the shareholder can use it. So ASBA is now mandatory now. Let us go through the book building process. Book building is a process undertaken to assess a demand for the securities proposed to be issued by a corporate body. So company will give you a option, a range. Those who want to purchase within this range, you can bid. Okay. So nowadays it is very easy on the internet. Just go to their site, you put the number of share you want to buy, you put the price at which you want to buy, and the money will be blocked. Money will be blocked. If you are allotted the share, it will be transferred to company's bank account, otherwise it will be unblocked. You can also try. And the price for such security is assessed for the determination of the quantum of such security to be issued by means of a notice, circular, advertisement, document, or information memoranda or offer document. In book building process, the price at which security will be issued to the public is not known because they are asking for the bidding. So how will you know the price at the beginning? While in case of offer for shares through normal public issue, price is known in advance to the investor. So that is called fixed price mechanism, which you learn in your accounts batches. Company will issue share at 20 rupees per share. It is written fixed price. But in book building process, the final price is not known. In the case of book building, the demand can be known every day as the book is built. So every day company receives demand for shares, and because of technology, internet, every minute they are aware now how many shares have been bidded, at what price they have been bidded. So they'll first keep a record or make a book of all the bids that they are collecting from different centers. Okay. This is book building. In case of public issue, the demand is known at the close of the issue. That is fixed price mechanism. The book should remain open for a minimum of 3 working days. 3 to 10 days are required, okay, for subscription list to remain open. Minimum 3. So if you look at any public issue coming out in future, look at the dates that they mention, and it would normally be 3 days. Book building is a mechanism of price discovery. In this method, offer price of securities determined on the basis of real demand for the shares at various levels in the market. So many people say book building is bringing democracy in the corporate world. Even the investor get a chance to determine the price at which he wants to buy the share. Okay. Book building means a process undertaken to elicit demand and to assess the price for determination of the quantum or value of specified securities or IDR, as the case may be, in accordance with SEBI ICDR regulations. So SEBI has issued ICDR. What is the full form of ICDR? Issue of capital and disclosure requirement. SEBI ICDR regulations have to be followed in case of book building. This we have already written in some other note. Private placement also, ICDR. issue of capital and disclosure requirement. Now next is only a price band is determined and made public before opening of the bidding process. So normally you will see, if you are an interested student, they'll mention a price band something like 200 to 220, 200 to 210. Maximum gap will be 20%. Okay, and then suppose you want to buy at 200, you can mark there 200 numbers, 210, how many shares. Okay, the spread of the price between the floor is minimum, in our example this is 200, and cap this is 220, should not be more than 20%. Okay, so this is a regulation right now. It means the cap should not be more than 120% of the floor price. So this number cannot be more than 120%. So for example, if I ask you what can be the upper limit in this case, 240. Okay, keep this also in mind, because in the exam, when I look at the model test paper and past exam paper, there are questions on this kind of sentences. Each line is important. Okay, SEBI guideline, each line is important, mark my words. And you cannot keep searching for such answers in the study material. If you know in advance, in few seconds you can solve. Issuing company appoints a merchant banker who is known as book runner lead manager. BRLM, book runner lead manager. So he is the boss. He will be appointed by the company that you please look after all my book building process. And then he is assisted by other co-managers. Sometimes there are more book runners and a team of syndicate members. So these are basically those other people who help the book runner lead manager acting as underwriter to the issue. So book runner, under book runner you have syndicate members. Okay, brokers, underwriters. Now who will try to collect the demand from the customer or client. BRLML sends copies of red herring prospectus to the QIB, large investor, SEBI registered foreign institutional investor, and to the syndicate members. So this is the role of BRLM. So he will inform all his clients, you can say, or the people from whom you can expect the subscription. BRLM also appoints brokers of the stock exchange called the bidding centers. See, ultimately who is in touch with their client? The brokers. Yes or no? You are more in touch with your broker. So therefore, it is better to also involve the brokers at local level who will inform their clients about a public issue. They accept the bids and application form from the investors. Broker, if you have a broker for share market, share trading, he will tell you every time this IPO comes, and he says, sir, please apply. Why you should apply? Because you will get brokerage. Is it right? He will also help you to complete all the formalities. These bidding centers place the order of bidders with the company through BRLM. They are liable for any default, if any, made by their clients who applied through them. So brokers have to be careful. Brokers, syndicate members collect money from the client or investors. Money received by them at the time of accepting the bid is called margin money. Underline. When you are going to bid, you have to also pay the amount. For some category of investor, it is 10% of the amount. For some category, it is 100%. We will see that somewhere below. Okay, and that is called margin money. Bids can be made through online. So I do online only. Now I don't go to brokers. Okay, on mobile phone only now. bids can be made through online, and transparent system of National Stock Exchange and Bombay Stock Exchange, depending upon the agreement of the issuer with the stock exchange or stock exchanges. So you can do the bidding now or application online also. You can go to your broker's site, and whenever an IPO comes, there is a icon there. You can click that. They will show this is the IPO which is opening, and then you click that. You will get all the details. You put the number of share, the price. If you have a bank account balance, it gets for the time being deducted from your bank account. A public issue shall be kept open for 3 working days, already discussed, minimum, and not more than 10 working days. An issue through book building system remain open for 3 to 7 working days. In a fixed price system, 3 to 10 days. In a book building method, 3 to 7 days. But sometimes what they do, they extend it also. For example, if there is a revision of price band, the issue period disclosed in the red herring prospectus shall be extended for a minimum period of 3 working days. Sometimes this period can be revised to 3 more days. However, the total bidding period shall not exceed 10 working days. Sometimes in case of revision in the price band, 3 more days they can extend. In other words, in case of book built issue, bid is open for a minimum period of 3 days, maximum period of 7 days. So in a normal condition, 3 to 7 days. But in case the price band is revised, then it can be extended up to 10 days. No revision in price band, 3 to 7 days. Revision in price band, 3 to 10 days. Now one more paragraph I have added from my side. What is the difference between fixed price method and book building method of the pricing of public issue? Fixed price means company will decide the price, buy it or leave it. Okay. Book building means they will only give you a range. You can bid according to your liking, and if the amount at which you want to buy is above the cutoff price, shares are allotted. That is the book building method, which is now generally used for all IPOs. Price at which securities are offered and would be allotted is made known in advance to the investor. Right? Investor know in advance this is the amount I have to pay. In case of book building, a 20% price band is offered by the issuer. Sometimes it is less than 20% also, I have seen. They may just give you 200 to 210. The 210 is not the 20% band. Okay. 20% is the maximum gap that is possible between the two prices, lower and the upper price, within which investors are allowed to bid. No problem. And the final price is determined by the issuer only after the closure of the bidding. So first they will collect all the application and they will make a list of, suppose 210, how many shares were applied, 209, how many shares were applied, 208, how many shares were applied. This way they will make a summary of number of shares applied at different price. What they will try to do, if at 210 they are able to get whatever amount they want. Suppose there are many applicants at 210, so what they will do? 210, close the issue. But if at 210 it is not sufficient, then they will take 209. In that case, they will add both the shares, number of share, multiply by 209, and if that is sufficient for their requirement, they will lock it at 209. If that is not sufficient, then multiply 208 into this. Is it right? This way, they normally, logically, they will start from the highest price and then go 1 rupee below, 1 rupee below, until they find a price at which their requirements can be met. And then all those who applied above 208 or 208 will be allotted. His question is whether this person will also be allotted. Yes, he is willing to pay up to 210, but we are only asking him to pay 208. But this person cannot be allotted because he says, I will buy only if the price is 207. Okay. Then one person asks whether this person who's applied at 210, will he be refunded 2 rupees? Yes, company will not keep it. For everybody, it will be 200. But again, there are some discount for retail investors under the SEBI guidelines. Okay. So all those things will also be there. Discount for retail investor, discount for employees, etc. So dear student, come to point number 2. Demand for securities offered is known only after the closure of the issue. But here the demand for security offered and at various prices is available on a real-time basis on the BSE website during the bidding period. If you are interested in capital market subject, then you should observe that on the day the issue opens and you watch some news channel dealing with capital market, they will keep on telling today this issue is open till 10:30, so many subscription have been achieved. At the end of the day, 35% subscription has been achieved. Okay. Nowadays, because of technology, everything is possible. So many paragraphs remains in the book, but actually they are not relevant today. Even in fixed price, they can find out at every point of time. Okay. Then fixed price method, 100% advance payment is required to be made by the investor at the time of application. Whatever is the application money, you have to pay. But in case of book building method, there are two numbers. 10% is required to be made by QIB, qualified institutional buyer, while other categories of investor, this again you underline, other categories of the investor will have to pay 100% advance along with the application. Like retail investors are there. Okay. They have to pay 100% advance. But qualified institutional buyer have to just pay 10%. Now there is one small wonderful example which will give you a general idea, a rough idea, how the allotment is done, how the cutoff price is decided in the case of book building route. Okay. This example is printed in your notes taken from ICI study material only. Suppose a company comes with a public offer of 3000 shares. How many shares it wants to issue? 3000. Suppose they have decided to issue 3000 shares. So in this case, the number is known. The company chooses the book building process for price discovery and decides the price band of rupees 20 to 24. So then the bidders will bid at 20, 21, 22, 23, 24. The company received the bidding as depicted in the table given below. At 24 rupees, bidding quantity is 500 share. At 23, bidding quantity is 1000 share. At 22, 1500 share. 21, 2000, 20, 2500. Okay. Can the company select bid price at 24? No, because in that case, only 500 shares can be allotted. Can the company select 23 as the cutoff price? No, because 23 means 1500 shares can be allotted. Even 23 will not be possible. Can company choose 22 as cutoff price? So let us see cumulative quantity. If I choose 22, we can allot 3,000 shares. So my cutoff price company will fix at 20. So these investors will be allotted the shares, and these two investors, Tata, bye bye, enjoy. Okay. So now see the note which the institute has given to you. In the exam, they can give you a different question. You have to see that company's requirements are fulfilled. Start from the highest price. Okay. And then if at that price, their requirement either it will be given in terms of share or in terms of rupees. Number is known, price is not. Still book building. Amount will be because the price band they have given 20 rupees. This is a simplified example, but otherwise sometime only they want to how much amount they want to raise, that can be given to you. So in that case you have to see at which price they'll be able to realize the desired amount. But if you look at the IPOs, the number of shares that they are going to issue is mentioned in that IPO, that this bank or this company wants to issue 3 crore share in a price band of 20 to 24. Now on the basis of the above table, the company would obviously want to sell all the share at the highest price of rupees 24. But as you see, at this price it will be able to sell only 500 shares, and at rupees 23 it can sell only 1500 shares. Therefore, in order to sell all 3000 share it has issued to the public, the company would have to lower the price by rupees 1. It means the company has received 3000 bids from people interested in buying the stock at rupees 22. All will be allotted at 22. It's not that first will be allotted at 24, second will be allotted at 23, and the third will be allotted at 22. All will be allotted at 22. So 22 becomes the cutoff price. Now the company will price the IPO at 22 or lower, but not at a higher price, since it did not receive enough bids to be able to get offering fully subscribed. So you can't put the issue price above 20, because above 22 means you will not get enough subscription for 3000 shares. Can you keep a little below? Yes, you can, but not above 22, because then the issue will remain undersubscribed. This is known as price discovery mechanism of the book building process, and the way most IPOs are priced these days. Good. If company raises more money, what is the harm? Well, nowadays the gap is very many. Yes, because they think that the price will rise in the future, so I should buy it at the. They will not get allotment if others are willing to pay 24. Why all should think? Why all should think? You think 20 rupees? No, because some people may think that this company's share price is worth 24 rupees. I think it is worth 24 rupees. So I will willing to pay 24, because once it is listed, the price may rise to 28, 30. Unity is a misnomer. People don't unite. Okay. Huh? And this is a huge country, no? How do you expect unity? So what you said is a theoretical possibility. If it is a small village where we are making an IPO, but if you are making an IPO in a country like India, then you can't really say what they want. So according to your estimation that this is the price which is good for me, you make an estimation. Number of shares. Generally this book building route, generally they get subscribed, and plus there is underwriting also. So underwriting is there in public issue. So many companies if they get an idea that our issue will not be subscribed, then they withdraw the issue only on the first day itself. Before actual launching, they withdraw. I have seen one or two companies withdrawing their issue. But if it is underwriting also, then there is no problem. Now, what we discussed in the last 2 pages have been summarized in the form of a flow chart. How does book building process work? Company plans an IPO via the book building route. Company will appoint a merchant banker as a book runner, issue a draft prospectus containing all mandatory disclosures other than price. Draft prospectus is filed simultaneously with concerned authority like SEBI. Book runner appoints syndicate members and registered intermediaries to garner subscription. Price discovery begins through bidding process. At the close of the bidding, book runner and the company decides upon allotment and allocation. One paragraph I have added today. Write down. How is book building better than fixed price mechanism? How is book building better than fixed price mechanism? How is book building better than fixed price mechanism? So write down. First of all, the book building process brings flexibility to the pricing of IPOs. Flexibility to the pricing of IPOs. Brings flexibility to the pricing of IPOs. Next line, right? Prior to the introduction of book building, a lot of IPOs were either underpriced or overpriced. A lot of IPOs were either underpriced or overpriced. This created problems because if the issue was underpriced, the company was losing possible capital. If the issue is underpriced, the company was losing possible capital. Okay. Sometimes the company also does not know what is the exact price I should charge. So let the public decide. There are companies whose shares are oversubscribed by 20 times, 15 times. It means it is underquoted, underpriced, and that is why there is so much of demand. So book building will reduce this problem of underpricing or overpricing. On the other hand, if the issue was overpriced, like it can happen in fixed price issue, you may say I want to sell at 120 rupees, investor wanted 110 rupees. So in that case, what is the problem? If the issue was overpriced, it would not be fully subscribed. Okay. So the chances of underpricing and overpricing is also less here, because then a lot of investor will bid and they will know this is what the price should be. In fact, there are a lot of economic thinkers who think that this range should be further broadened. Why it should be just 20%? It should be even bigger range, because it's possible that even 20% range is not good for underpricing or overpricing. One author had said in one newspaper article I have read, only you put the lower band, remove the upper band. Okay. And one author have also written no band, let the public bid. Okay, anything. Then that will be the true book building process, where the investor has all the power to decide the price. But for administrative and other reasons, this price band is there. Okay. So now one more line write down for this answer. With the introduction of book building process, such events no longer happen. With the introduction of book building process, such events no longer happen, and the primary market functions more efficiently. And the primary market functions more efficiently. And the primary market functions more efficiently. Okay, come back to your notes. In your ICI module, there is a paragraph which says some interesting facts about the book building process. Means these are all potential questions for you. The issuer may mention the floor price, only floor price, or price band in the red herring prospectus. Second line, if the issuer chooses not to disclose price band or floor price in the red herring prospectus, the price band or the floor price shall be disclosed at least 2 working days. Underline, at least 2 working days in case of IPO and at least 1 working day in case of FPO before the opening of the bid. So in RHP, it is not compulsory to disclose the price band or the floor price in RHP. But if you are coming out with an IPO, then 2 days before the either floor price or price band has to be disclosed. If you are coming out with a follow-on public offer, then 1 day before you have to disclose the price band or the floor price. Where the issuer opts for price band means 200 to 220. Instead of floor price, means only the minimum price, it shall ensure that the spread between the floor and the cap of the price band should not be more than 20%. This price band denotes the range of bidding. Okay, so this we are discussing many times. In case of composite issue, what is composite issue? Public issue and right issue. Price of a public issue may be different from the price offered for right issue. Okay. However, justification for such price difference will be provided in the offer document. The bidding terminal shall contain online geographical display of demand and bid prices, updated at periodical intervals not exceeding 30 minutes. That means every 30 minutes you have to update how many bids have been received, number of shares, price. At the end of each day of the bidding period, the demand including allocation made to anchor investor. Underline. There is a paragraph on the next page about anchor investor, so we'll discuss in detail that time. For that timing, you write down anchor investor are the first investors in the IPO and are qualified institutional buyers. What I have underlined, you write down if you want, otherwise it will appear in the notes somewhere down the line. At the end of each day of the bidding period, the demand including allocation made to anchor investors shall be shown graphically in the bidding terminals of syndicate members and websites of recognized stock exchanges, offering electronically linked transparent bidding facility for information of public. So at the end of the day, you can log into the BSE website and you can see how many shares were bidded, at what price they were bidded. So there is more transparency. About anchor investor, we will discuss in few minutes. So these are the first investors in an IPO and are qualified institutional buyers. So they are issued share 1 day prior to opening of the IPO. Okay, in order to bring confidence in the investor, some qualified institutional buyers are allotted share 1 day before the opening of IPO. These are sophisticated investors, highly qualified investors. They have the knowledge of the market. They know what is the price. If they support the issue, it creates confidence. Okay. If they don't show interest, that means public will also be reluctant to invest. So this was also introduced in our capital market called concept of anchor investor. Okay. Next point, the investors except SBA or ASBA, investor may revise their bids. Who are not allowed to revise their bids? Those who have applied through ASBA. What is ASBA? Again, it is written in the next paragraph. Application supported by blocked amount. It is printed in the next paragraph. So that time we'll discuss. For the time being, now what you have to do, if you have to apply for IPO, you don't have to send a check or a demand draft to the company. You can go to the bank and you can tell the bank, please block my amount for this application I am making. Money will not be transferred to the company's account immediately, but it will be blocked by your bank. If you are allotted the share, then only the amount will be transferred to the company's account. If you are not allotted the share, then the amount will be unblocked. The advantage is you will continue to earn interest on that. Plus the company also does not have to bother about refunding. All this administrative process will completely come to an end. And this will also, let's say, encourage the investor to invest, because they may feel, what if I apply the share and if I don't get allotment, will I get the refund, etc., etc. So this will actually increase more and more investor participation in the public issue. Good thing. ASBA. So they are not allowed to revise their bid. The issuer, in consultation with book running lead manager BRLM, determines the issue price on the bids received. Okay. Issuer, this lead manager, stock exchange, they all sit down and decide at what price the share should be issued. On the determination of the price, the number of securities to be offered shall be decided. Once the final price is determined, those bidders whose bids have been successful, like that example we saw, that means those who have bidded at or above the final price, shall be entitled for the allotment of these shares. Understood? So maybe in the exam you will be asked to solve a numerical question for few marks, where you may be asked to find out the bid price, the cutoff price. So you have to choose that price at which the desired number of shares can be issued or the desired amount of funds can be raised. Now, next is the concept of ASBA. ASBA means it is an alternate payment system for book build issue launched by SEBI in August 2008. Initially, ASBA was mandatory for public issue going through the book building route, and it was optional for other public issue, but now payment has been made. Payment through has been made mandatory by SEBI for applying to any public issue of equity share from January 1st, 2016. To just complete one word there, payment through ASBA. I think it is printed in your book. Payment through ASBA is mandatory for all public issues. Okay. So, okay. Next point number E. ASBA is basically an application. Okay. So how does it work? Understand. Then maybe you will also apply soon. ASBA is basically an application by investor for subscribing to an issue containing an authorization to block the application money in the bank account. So once you fill that form, your amount is blocked by the bank. Now you can't use it till the allotment procedure is over. Okay. But you will continue to enjoy the interest on it, whatever interest you are earning. Earlier, if you send the application, you receive the allotment after 40 days. For that period, you are losing the interest. And if you are not allotted again after 15 days, you will get the refund check. So for 30 to 50 days, your money was not generating any income for you. So therefore, this SEBI got this idea about ASBA. Money remains in your bank account. An alternative payment mode for applying in primary issues. See the benefit. If they ask you, this is the benefit of ASBA. It has helped investor do away with getting demand draft or checks made for payment of application. Is it right? So no need to go to bank, get a demand draft or attach a check with your application form. All this you can avoid. Therefore, once money stays in one's bank account until allotment of issue takes place. There is no hassle of refund of fund. Hassle of refund. Because in case of less or no allotment of share, the amount remains in your bank account and it is unlocked, unblocked by the bank, and then you can use it. The advantage is that one earns interest even on the blocked amount until it is debited for allotment. Now one example also they have given in your book. Example, Vadodara based 20 Microns Limited was the first company to come out with an IPO through the new Security and Exchange Board of India guideline for applications supported by blocked amount in September 2008. Which was the first company to use ASBA facility? 20 Microns Limited. General knowledge question. Okay. Come to para next. Process of ASBA. Already we have discussed, some more discussion. Process can be explained with the help of an example. Now what you have to do, an ASBA investor shall submit an application to the self-certified syndicate bank. Underline. In one of the ICI model test papers, there is a question on this point. Can you believe from which line they can ask you a question? Which I am going to take soon. SCSB means self-certified syndicate bank. So there is a long list of banks who are allowed to collect money under ASBA. Okay, all major banks are allowed in India. So if you have an account with State Bank, ICICI Bank, HDFC Bank, they can collect your ASBA application. An ASBA investor shall submit an application to the self-certified syndicate bank with whom the bank account has to be blocked, is to be maintained. Now I have written one line for your benefit. SCSBs are those banks which satisfy the conditions laid down by SEBI. Write down. Your question is, who are these banks? These are those banks who are willing to satisfy the conditions laid down by SEBI. And then when I did some research on this, I found most of the banks, scheduled banks, they are eligible. If that bank is not self-certified syndicate bank, then you have to go to some other bank, open an account, deposit the money. But most of the banks are. That is what I have seen. So theoretically your question is okay, but practically I think all banks, because banks are also happy, na? They keep money of the customer, give them just 4-5% interest, and use that money for lending for 20% or 18% or 14%. Anything you keep with the bank, they'll be more than happy. Okay. Yes, bank always look for customer who will keep their money with them because they get money at a lower cost and they charge high rate of interest. So SCSB will then block the application money in the bank account specified in the ASBA. The application money will remain blocked in the bank account till the allotment of security or till the withdrawal or failure of the issue or till withdrawal or rejection of the application. In ASBA case, money remains in your bank account only. Then the 15 days condition is not required only. Nowadays, everything is working on system. Okay. So all these are software controlled, whether money will be released within 15 days or not, etc. So it's all now software based. I don't think there should be a problem. So why do you ask questions which normally school level student ask? Sir, ऐसा होगा तो वैसा होगा. All these are taken care of. These are big banks. It's not that, but your liquidity is not available. But your point is, what if the banks do not release in 15 days? Normally, it should not happen. Investors will shout at the bank. They will make the bank remember that now you should release our funds. It's not a small amount, and it's not one or two investors. Lakhs of investors are there. So therefore, procedurally, these are all sound system. It will not go wrong. The SCSB shall upload the details in the electronic bidding system of the NSE or PS. So when you apply online also, all this takes place automatically. The software is designed. The bank's website is designed in such a manner that it happens. Don't bother. After the basis of allotment is finalized, the registrar to an issue shall send a request. Once your allotment is done, the registrar will send a request to SCSB for unblocking the bank account and transferring the allotment money to the issuer's escrow account. Means a separate bank account, only meant for collecting the allotment money under the issue. This money for that timing you can't use it for any other purpose. So all money will be first deposited here, and suppose the issue is withdrawn, suppose there is no allotment, the bank account shall be unblocked on the information received from pre-issue merchant bankers. That's it. So therefore it will work, don't worry. So now you draw a small diagram for ASBA. Briefly, one day before the exam, you can just quickly look at the diagram. So first step is the applicant will submit one ASBA format SCSB. Okay, you can do online also. ASBA format SCSB. That bank will block the amount blocked. Shares allotted by the company. Shares allotted by the company. And point number 4, remaining amount if any unblocked. Remaining amount if any is unblocked. This is the summary of ASBA. Then now you answer some simple multiple choice question. All these questions are taken from your model test papers. So it will be there in your model test paper some. The full form of SCSB is self-credited syndicate bank, self-created syndicate bank, self-certified syndicate bank, none of these. Self-certified syndicate bank. This question is there in one of the model test paper on ICI website. Dash is an offer document containing all the relevant details except that of price or number of shares being offered. Letter of offer, draft offer document, a breached prospectus, red herring prospectus. The right answer is yes. Student is saying red herring prospectus. Computer G is also saying the same. One more chance, okay? In a public issue by an unlisted issuer, the promoter shall contribute not less than 20% of the post-issue capital, 20% of the pre-issue capital, 25% of the post-issue capital, 25% of the pre-issue capital. So what have you learned? 20 or 25? 20% of which number? Post-issue capital. Okay. Do you want one more? Yes. Come on. Which among the following are the effects of bonus issue? Yesterday we have discussed bonus issue also. Share capital gets increased, liquidity in the stock increases, accumulated profits gets reduced, and all of the above. All of the above. Sure. Final. Computer lock D. Right answer. No amount. The bonus share shall be made out of. Yesterday we have discussed this point also. Free reserve only. Either free reserve or revaluation reserve. Either free reserve or securities premium. Either free reserve or revaluation reserve or capital reserve. So what is your IPCC or intermediate accounts knowledge telling you? B, C, yes. Your knowledge is good. One more. Dash are negotiable certificate with publicly traded equity of the issuer as underlying security. A. Global depository receipt. B. Share warrant. C. Share certificate. D. Convertible warrant. One Mr. person is saying A. You don't know. One more. C. Share certificate. Are negotiable certificate with publicly traded equity of the issuer as underlying security. We have discussed this. It's written in your book also. In one of the sentences, open book exam, search and tell me. Yes, those who have not answered A will search and tell me where it is written. So if you go to the definition of GDR or ADR, this line is printed there. I am telling you that you have to read properly because you can't find the answer of such questions in short notice in the exam. Is it there? So the answer for this question was GDR. GDR is issued in America or other country, and the publicly traded equity share of the issuing company is the underlying security. This is the definition of depository receipt also. Okay, one last chance. Post-issue monitoring report has to be submitted by the dash dash dash. Who submitted the post-issue monitoring report? Broker, underwriter, merchant banker, or registrar and share transfer agent? One person is saying C, merchant banker. One more person is saying merchant banker. One person is saying registrar. More vote for a merchant banker in the class. So we'll go with public opinion. Merchant bank. You want to write the question? All questions are there in the model test paper. You will find them. Okay. What is a green shoe option? Have you heard green shoe option? Never. In your law syllabus? Never. Many students wonder why this term green shoe is there. Does it have to do anything with green color or shoe? No. Green shoe option is a post-issue price stabilization mechanism, which I am going to discuss in the subsequent paragraph. But this strategy, this concept of post-issue price stabilization mechanism was first used by a company in USA. Was first used by a company in USA. The name of that company was Green Shoe, some private limited or some Green Shoe Limited, let us say. That is the first company to use this mechanism, and after the name of that company, this option is called Green Shoe option. Okay. The name of this company now has been changed also in the last few years, so don't bother. But only you're curious, why Green Shoe option? The reason is it was first issued by a company whose name was Green Shoe. It is an over allotment mechanism also. It is an over allotment mechanism. Over allotment means company will allot more shares. Company will allot more shares than the number of shares they have issued. How is it possible? So if you want to apply Green Shoe option, then at the time of public issue only in the prospectus, you will have to mention that this issue is subject to Green Shoe option. Now first you understand some basic logic behind this Green Shoe option. When the company issues the shares in the IPO, immediately after the shares are listed, there are two possibilities. Which are the two possibilities? Either the price may fall or the price may rise. Okay. So if the price falls, this Green Shoe option mechanism will help you to raise the price. But if the price rises, maybe it will help us to reduce the price. Okay. Many times it has been observed there is a huge demand for these shares, but the company is not able to satisfy so many shares. So therefore they issue little more. So when they issue more than the legal limit, supply increases. the price is stabilized. Okay. Law of demand and supply applies everywhere in the stock market also. So if the price is low, you raise the demand, price will rise. If the price is high, you increase the supply. The price is high, increase the supply, then price will fall. So that is green shoe option, which is basically in case of green shoe option, the company has an option of over allotment also. Company has an option of over allotment also. Okay. Say for example, company wants to issue 1 lakh share. So as you know, 20% share will be issued to promoter, 20,000, and 80%, 80,000 to be issued to non-promoter. And suppose the issue price is 100 rupees. Okay. And this is subject to green shoe option. So company will appoint one stabilizing agent. He's usually that underwriter or that merchant banker. Okay. Under the SEBI guideline, green shoe option is only possible up to 15% of the issue size. So what is my issue size? 1 lakh share. 15% of 1 lakh, 15,000. So how does it work? This promoter will transfer 15,000 shares to stabilizing agent. From their shares, they will transfer. You can call it lending also if you want. So how many shares now the stabilizing agent can issue to the public? 80,000 plus 15,000. So he will issue 90,000, 95,000 share to the public. He will receive application on this 80,000 also. The application money received on this 80,000 goes to the bank account, which is meant for keeping the application money. This application money on this 15,000 goes to a separate account, which we will call GSO bank account. What we'll call GSO, green shoe option. So in the bank account of the GSO, they will receive 15,000 into 100. How much is 15,000 into 100? 15 lakh rupees will come. 15 lakh rupees will come. And SEBI gives them 30 days only for price stabilization. SEBI gives them 30 days. Now, in next 30 days, if the price falls below 100 rupees, what this stabilizing agent can do, he can purchase the share from the market. He can purchase. Okay, out of which money? This money, which is kept in the GSO account, GSO bank account. Okay, so I am going to open one share account of this share account for stabilizing agent, which he'll purchase from the market. A GSO share account, actually it is a demat account. On day 1 the price was say 101. He will say okay, don't do anything, let it be. 102, don't bother. 90, price has gone down, act. He'll purchase. He will purchase the share from the market. Okay, let us say he will purchase 2,000 share from the market. So now he will have 2,000 shares here, and he has to pay 2,000 into 90, 1,80,000. Okay. Again, the market price falls to 80. He will artificially create the demand by purchasing the share. So when he purchases the share, the price may rise. Again, this is stock market, you can't say. So let us say he purchases another 3000 share at 80 rupees, 2,40,000. And how many shares will be with him now? 3000. Okay, so this way it continues. One more I will take. Suppose 95 on next day. Huh? 2 plus 3, 5,000. Yeah, 2000 plus 3000. So we have 5,000. One day the price is 95. He purchases more shares. So let us say 5,000 shares he buys at 95. How much is that? And his number of shares will be 2000 plus 3000 plus 5,000. Okay. So this way he tries to do the price stabilization, because when he buys the share, it creates demand in the stock market. So how many shares he has now? He has 10,000 shares now. Suppose he could purchase only 10,000 shares. Suppose he could purchase only 10,000 shares. These 10,000 shares will be returned to the promoter. This 10,000 shares will be returned to whom? To the promoter. But promoter will say, we have given you 15,000 shares. Give me 5,000 more. Now from where that 5,000 share will come? That 5,000 share company will issue to the promoter, and the payment will be made out of the GSO account. So 5,000 share will be issued at what price? Issue price. 5,000 share will be issued to promoter by the company. So tell me, after this process is over, total number of shares in the balance sheet of the company will be 1 lakh originally issued and plus 5,000 more to the promoters. So that is why it is called over allotment mechanism, because you will end up in this example allotting total 1,05,000 shares. Then one last thing that is pending, this 10,000 share I have issued to promoter, this account is closed. But there is some money left in this bank account. We have 15 lakh received here. Just tell me what is the total of this four numbers. 13,95,000. Is it right? Is this gentleman right? Okay. So total is 13,95,000 payment to the market and to the company. What about that remaining 1,05,000 rupees which is lying in this account? Will the company get it? Will the promoter get it? Will the stabilizing agent get it? Or will it be transferred to investor education fund? Investor education fund. This 1,05,000 surplus which is left now will not be transferred to either promoter. Promoter got his shares now. Promoter had given me 15,000 share. I have returned. The promoter is happy. Huh? But under green shoe option it is okay. Okay. Under green shoe option it is okay. Company will not get it. Company had got whatever they have issued. Stabilizing agent will not get the balance amount in for him. Maybe he will get some fees for this purpose, but not the entire amount. So SEBI says transfer it to investor education fund. This is green shoe option in brief. Loss, how it will be loss? You will not buy only at higher price. You will buy only at a lower price. You will buy only if the market price is less than 100. So they say ki higher is okay, but they will not let the market price go down. It will cause a bad name to the company. It will cause some loss of goodwill to the company. See what kind of company is this? I invested and the price is now down. Okay. So therefore there can't be loss because he will not buy at a higher price. If he buys at a higher price, the price will further rise. It will create a chain reaction. Okay. First, he made an issue of more share because he visualized there is excess demand for this share. So he made 15,000 more share to the public so that post issue price does not rise to a large. The supply he had increased in the beginning. Later on, if the price falls, then he can create the demand. Okay. So now we will take break.